Okay, I think I'm going to also talk to the class in here. I think let's have our class time start time be moved back to 6:05. There's a class that's scheduled in here until 5:59, and they seem to use all the time. So let's just from now on assume that we're going to meet at 6:05. So uh, yeah, not ideal, but you know. Okay, so let's go into chapter 3 handout. Okay, so chapter 3 handout, the difference in the chapter 3 handout between the chapter 2 handout is the chapter 2 handout is when you initially have a purchase of the investment. And chapter 3 is what happens after you've had it for a year. So you made this investment, you've had it for a year, and now you got to take the financial statements and put them together. So how are we going to do that? And um, again, we have to eliminate, just like we did before, we have to eliminate the investment account. Oh, looks funny here. Okay. All right. So this is problem page, I think it's on page 2. No, it'd help if I had page 2. Okay. All right. So the nice thing about chapter 3 is we're assuming that everything is purchased at 100%. So we're buying the entire company. There's none of this. We own 30% of it. We take 30% of the stuff. It's all 100%. Okay, and down here we get the calculations for what this company is worth, the identifiable assets. So we take the fair value of the assets, the fair value of the liabilities, and we're going to come up with a fair value of the identifiable assets. Okay, so that looks a little funny. Let's make this a different color. I'll make this green. Oh no, we have a bunch of colors. We'll make it orange. Okay, so these are the identifiable assets. So this is what the company's worth if you just add up the identifiable assets. This is what we paid for it. Okay, so I'll put it down here. So how much goodwill do we have? We can identify these assets.
Is it 25,000?
Yep. Yeah, so we're gonna have the cash. I'm gonna move this up a little bit. The cash price paid. Sorry. Cash price paid. We're gonna take these identifiable assets and we're gonna subtract them. And so the difference is going to be our goodwill. Okay, so this is going to be our goodwill. And what color will we make that? We'll make that green. How about? The hardest part about accounting is figuring out what color to make the numbers. Say something funny about making reports and making them look nice and all that. I had the spelling error here. Um, we were when I was at US Steel, they gave us these computers, these laptop computers, and they gave us training 6 months later, which of course we didn't sit around and do nothing for 6 months. So we all knew how to use the computers. So anyway, when we were in there, I just kept going through my reports and, putting colors on them and did all this wacky stuff just because I was bored. And the I got a call from the director of internal audit, like, this is a really good report you said. There wasn't anything really good about it. It looked really nice, but it had nothing to do with with what we was reporting. Okay, so let's see. Going down here, we have our well, here's our investment. So this is what we're going to try to get rid of. And you'll notice it's not the same price as what we paid for. That's because the years gone by, and we have income and all the other stuff that we did before. Let's change that too. Okay, so here's this investment account. And this is what we're going to eliminate. And we go by from last time. Oh, here we go. Sadie. And we did stock and assets the first time. And be careful on this one because there's going to be something a little bit different on. Okay. So stock and assets. So let's take those two first. We've already done those before, so we'll do those first, but there is a little twist to the stock one. Okay, so we're going to get rid of their stock. Now, the first two are the same as before. Hold off on the retained earnings for a second, though. Let's make a color for those. Let's make those that indescribable color. Now, the retained earnings is a problem because we have to come up here for our beginning retained earnings to come off the book. So retained earnings is now no longer I don't want to do that. Don't do that either. Retained earnings is no longer the down there. It's going to be up here because we actually have things going through the retained earnings that we didn't have before. We didn't have any income before when we first did it, but now we do. So the new spot for these is going to be up here. So this retained earning, and the reason being is we're going to back out these other numbers here separately. Okay, so let's see if we can. All right, so we're going to come down here to our investment. All right, and take out our stock. It's going to be all those together. Trying to get these all on the same sheet. All right. So any question on that? So the new thing is this. Now, instead of doing it down here, it has this number that we is calculated. We're gonna do it from up here at the beginning. Retained earnings are coming off. So here we're taking off the equity. And we're taking off the beginning retained earnings. Question on that? Okay, we got to go to the assets. And the excess assets over book, and this is done at the time that we do this transaction. The excess over books was 10,000 on land and 20,000 on building. And let's get a color for that. Assets, let's make them what, turquoise. Okay, so these are the assets that need to be put on. And I'm going to come down here and add the one asset that I always forget. Goodwill. Okay. So our land goes up by 10,000. Our building went by 20,000. I'm going to check that just to make sure I didn't do that wrong. 10,000, 20,000. Okay. And then the one that I always forget is Goodwill. Yep. And that was 25,000, I think. Okay, so this will be our assets. That is not right. 55. Yeah, yeah. I think I grabbed it wrong. There we go. Thank you. And so this is kind of what we did last time, a little bit different in that we do the retained earnings up here at the beginning, retained earnings. Okay, now going back to our journal entries. So we just did the S and the A. From like last time. Now we're gonna do these other ones. Dividends, income, and additional expenses. Okay. So let's go to our problem. Wait, I'm going the wrong place. Here we go. Okay, so we're gonna come to dividends. Now, dividends, you recall dividends are a little bit odd when we're doing our investment. And if you recall, these would reduce our investment, right? So if we're trying to get this investment off the books, this is where it becomes a little bit odd, is that we'll actually, this dividend account will increase our assets. We're trying to eliminate this dividend account because remember, nobody got those $5,000 of dividends. No one outside the company. That's simply inside the company, a company that we own 100% of, we got $5,000. It's just shifting cash from one thing we own to another thing we own. The only dividends that actually went out were the 60,000. So we do a consolidation, we only want that 60,000 showing us the dividends going out. So we had to eliminate this 5,000 of dividends. Yeah, let's give that a color. What color should we make that? Purple. All right, so 5,000, oops, up there. 5,000 of dividends. Okay, we got to get rid of the income. That's next. Now, here's why we have to get rid of the income. We're going to count the income that comes out from jamming the revenues and the cost of goods sold and the expenses together. Those are going to come out to be our income that we're going to have in total. So it's going to look like this. So we got to take off the 19,000. Let's give that a color. Red. Okay, so we're actually pretty far through this thing. One more thing to do. We got the dividends. We got the income. And so now we have to do the expenses. Okay. We have to figure out what the expenses are going to be. What additional expenses are we going to have?
Depreciation expense?
Yep. I'm going to do something here. Additional expenses. Okay, we have a well, the land, we don't depreciate land, so that 10,000 for land, we're not going to do anything with. But this no, equipment. No, buildings. I don't know my assets. So buildings. We have 20,000. I'm just gonna write it out. 20,000 divided by what, 10 years? I forgot I'm in Excel. 2,000. Oops. So this would be additional depreciation expense. Oh. Yeah. And let's make our expenses. Have we used green yet? I don't think so. Have we? No, we have not used green. Okay, so the additional depreciation expense is green here. And by the way, if you look at this, at the income for bill company, you'll notice that they have 21,000 on the books and we have 19. Well, the difference is that 2,000. All right, so additional expense. That means there's a squirrel at my front door. All right. So we're gonna have to add 2,000 to our expenses. Grab one of those. Oop. And coming down here. No, wrong, bad, marquee. It's gonna come out of our asset because we've had this asset for a year now. So we added 20,000 to it, but now we're gonna depreciate 2,000. So don't do what I was trying to do there earlier. Put it up here with the assets. Because we've had this now for a year, so we added 20,000 to the assets, but now we've used a year of it, so 1 out of 10 years of it is being taken off. So everything goes through the investment account except for the additional expenses. Additional expenses will actually decrease the assets. And so what's going to happen is these are going to keep getting put on the books until after the end of 10 years, this is going to disappear completely. The land should still be there. Okay, now hopefully, this over a little. We have to add all these up. Okay, so we're adding up the assets. Scratch that. The revenues or yeah, revenues, sales or revenues. Cost of goods sold is going to be an expense. So I'm going to put this in as a negative. That's money going out. Or actually, it's not money going out. It's goods. It's goods that are leaving. We had these goods, just like as if we have cash that's an asset. We had these goods that were an asset, and they left the place, so we no longer have those assets. Our expenses will be the 15,000 plus the 5,250 plus the 2,000. And again, those are expenses. I'm gonna put them as a negative. You don't have to put them as a negative, just as long as you remember to subtract them. Amortization expense is 0. And our investment account is down to 0. The investment income, because it's not going to be included in our consolidated income. And you'll notice something. The income for those are exactly the same as the company income, and as they should be. You know, we put basically all this added up to 21,000 going on our income, and then we took off 2,000, so that 19,000 is already in there. So our total, these two will come out the same. So if you do it right, if they come out differently, then you know you gotta go back and take a look at it again. Any question on that? Because remember that 79,000, that does have the income from the subsidiary in it. It went through our investment account. But when we took out that investment account, you know, we're gonna add all those things back in, just like our regular income. And so here's what this would look like. If you were to get a consolidated financial, let's say consolidated income statement for Amy, would look like that. So that would be the consolidated income statement. Each of the,
Can you go back? How did you get the 22,250?
oh, adding all three of these together.
Okay.
Yeah, and it's a good point. So these are the expenses for Amy. This was Bill, but we had additional, we put an additional asset of a building on the books. of 20,000. So this is the depreciation of that excess. And so that's where we got those. Yep, so all three of these together. We're gonna do a book problem next week that has, I think, yeah, I think we'll end up with a negative. We have actually, instead of an excess asset, we have it's a reduction of the assets. And it'll be a reduction of the, expenses too. We'll leave that fun for next week, though. Okay. Now, this income has actually been wiped out. We've taken all that off the books. The income of 19,000 plus the 2,000, that's all come off the book. So this income really isn't there. What you're going to end up with is the exact same retained earnings of the parent company, in this case, Amy, is going to be on there. So we have 350, 65 minus 65. The income just comes from the income up here. And if you'll notice that income is the same as this income over here. So the income does not change with the consolidation. It's exactly the same. And I'm going to insert one of my world famous. Hey, you guys took off you guys did it because you hate my shapes. Where are the shapes at? Shape. Oh, look at that. They added an extra hoop to jump through. Of course, it's in invisible blue. Let's make it red. Okay. So this is the income coming down. And the dividends, the Amy company paid out 60,000 in dividends. Now notice that these dividends of 5,000 never went to anyone else outside of the company. These were paid to Amy. No one outside got those dividends. So Amy's dividends are the only ones that were paid out. So this would just be the 60,000. So you'll notice that those two numbers are exactly the same too. Oh. It's not really clear, but. And so you'll notice that this should come out to be exactly the same. These are exactly the same numbers as here. Because if you think about this, this whole equity section, this is to nobody. There's no external shareholders that have this. This is all owned by Amy Company. So anything that's in the Amy Company will actually be our statement of retained earnings. It'll also be the only thing that's in our equity section. Okay. Coming down. Now for assets, I'm gonna do something here. So for assets, debits are going to increase. And credits are going to decrease. This is only for assets. Actually, it's for assets and expenses. But on our balance sheet is only for the assets. Okay, so we're going to take the 50,000 and the 26,000. And you'll notice that 5,000 of dividends, that means that instead of 31,000, they have 26,000. And instead of 45,000, it doesn't make any difference in total. So 76,000 of cash. Okay, land will be 100,000 plus a 60,000 plus 10. Was it 170? Building and equipment. 120 plus 45 plus the 20, but then we depreciated 2,000 of it. So that will be taken off. Doesn't look right. 120 plus 45, 65, 85. Yeah, that's right. 85 minus 2 is 183. Equipment. And nothing too fun in there. We'll just add those together. Okay, now this investment account, if we do this right, it should come out to 0. So we're gonna take the 239, we're gonna add the 5,000 and then minus the 170, the 55, and the 19. We're gonna add the 5 minus that and 55 minus 19. Yay. And that's what we want it to be. We want it to be 0. And don't forget the goodwill. Just so you guys know, about half the time when I show these, I forget the goodwill. So that'll be something for you guys to look forward to. You see me goof it up. Okay, so this is so 859. The total assets. All right, let's go down below here. Now down below, we're gonna have these. The first two. Add those two together, so we owe 70,000 and 25,000. Okay, now this equity section. The only thing that's gonna be left are these over here. What color haven't I used yet? Blue? Oh wait, I don't want to do that. Hold on, I'm doing something stupid. Blue. The only thing that's gonna be left are is the owner equity from Mary Company, not Mary, who's this? Amy Company, because this entire section is gone. There are no retained earnings for there's no outstanding shares of stock. There's no additional paid in capital. Those are all gonna be gone. So this will actually just end up being, oops. You could do plus 30,000 minus 30,000, but it's just gonna be whatever the parent company has. The only thing that's left.
Professor, we don't do anything with the retained earnings of the 81,000. We don't touch that.
No, you don't. And the reason you don't touch it is because those are completely eliminated up here. You notice that when we consolidated those, it just comes out to the same as the parent. So this entire 81,000 was eliminated. Yeah, we eliminated the beginning retained earnings, we eliminated this income, and we eliminated the dividends. So yeah, good question. This one, even though there's technically nothing here, it was actually eliminated up here. And then for the year, the income and dividends were also eliminated. And if we did it right, no, that is right. Yep. That's it. Yeah, so this would be the and again, when you see the consolidated income statement or financial statements, it'll look like this. And that'll be the two companies smushed together, but you won't see the actual smushing. You'll just see the consolidated totals. So anytime you see a large company, what they usually will show you is the consolidated totals. For instance, Ford Motor Company, they'll have Ford, making their cars, but they'll also have other companies that they own. And so you'll see financial statements for Ford, but then you'll also see the consolidated financial statements. And that's basically everything they have will be in there. Okay, let's go to problem 3. Problem 3, I'll help you figure out together. We'll figure out the fair value of the identified assets. And then we'll also figure out the goodwill together. And then I think I'll be quiet and let you guys work on it. Okay. I just realized that my year for this is different than the handouts, I think. Or is it the same? I don't know. Doesn't matter too much. The problems are the same. Okay. So we got the fair value of the assets. And then what do we do? So we bought this company out and it has assets valued at 464,000. They don't tell us what the book values were. These are all at fair values. Oops. They don't tell us what the book values were, but tells the fair value. And so this 16,000 plus the 32,000, that's included in the 464,000, includes these two. You can figure out what the book value is for this. Okay. What do we have to do next?
Deduct cash.
Yeah. So we're gonna minus these. This is what we owe. Oh, wait a minute. I did this wrong. Hold on. Yeah. Okay, I'm gonna try this. It's the third or fourth time. Well, anyway, I'm gonna try it again. And this is, I'm showing these as negative because this is what has value. This is what we owe other people when we bought this place. And so this is the fair value of the asset, what they would usually call the identifiable assets. I forgot what color I made that. Doesn't matter. Okay, so the fair value is that we paid hey. Cash price paid was 360, so we have so the difference there is 40. And so this is gonna be our goodwill. So our goodwill will be goodwill, sometimes called the unidentified asset. It is a little funny, the terminology of it, unidentified, because it sounds like you don't know what it is. But anyway, yeah, so this will be the goodwill, the unidentified asset. Okay, I am going to stop talking and let you guys see if you can figure it out. We'll go through it. Don't be afraid to make a mistake. We're gonna go through it anyways. So remember Sadie. Copy Sadie over. Uh, let's try that again. Oh, I see what I did. Okay. Ooh. I think I made these columns way too big. Is that a yawn of excitement? I bet it was, right? What did I make? Before. Yeah, I think you should have got 272 for the stock. Assets. 16,000 for land, 32,000 for building. And also, yeah, the goodwill. Those together should be your assets. $88,000. Yeah, I think that's right. So this will take the owner's equity off at the beginning of the period. And then we're gonna have to unscramble the dividends, the income, and the excess expenses. Excuse me, dividends are wacky. Why? What's something about dividends on the other entries? They're unusual in that they'll actually add to the asset we're trying to delete. We're kind of unmixing the cake. The same way before when we did the equity set method, we would subtract the dividends from the investment. When we get rid of the investment, we're gonna add them back in. As if they never happened. Okay. Income. What do I have for income? Okay. Oh, shit. Okay, so income, we have to take that off the books. You know, so this is usually a credit balance, so we're debiting it. And we're also gonna take it off of our investment because we're trying to make that investment disappear. Now, that income from the subsidiary will be in our consolidated income. It's already in our regular income. Next thing we have is E. E's like B, okay. Okay, what do we have for our expenses? Sorry, additional expenses. We have the building.
3,200.
Yep. Yeah, so take the building, the excess is I just deleted the, what did I do here? Okay, let's try that again. And again, the land, we don't do anything with the land just because it doesn't depreciate. Okay, and by the way, we should have also made, we could have probably calculated that 3,200 by just looking at the difference between these two, right? 33,600 and 30, that should be 3,200. Okay. So now we're just gonna jam them together. Let me make this a little bigger. Yeah, I think so. This one, we're at a credit balance, so we're gonna subtract it with a debit. And this should come out to the 126,400. And it does. And so all of this from bill company is included in these consolidated totals. The income is exactly the same because we already picked up the income for bill company on the income from the investment. But now we're picking it up as revenues minus cost of goods sold minus expenses. And coming down here, you can do the math, but it's actually going to end up just being these. Because retained earnings are gone. The income was eliminated up here. And it's going to be the same as here. This is actually that number. This should be as a negative. taking away from retained earnings. The moral of the story, if you look, these are exactly the same. These are exactly the same as these over here. Yeah, and there's a reason for that. Nobody actually owns this other stuff. This stuff never happened outside of the company itself. There are no shareholders. They got those dividends other than Amy Company. Okay, let's go to assets. We'll post the debits, subtract the credits. One gets missed a lot, I think, is this one here because it's tucked in right underneath between the two fun things. The fun things are the building and the not so fun things are the investment, but don't forget that. And then also down here, the goodwill. That what you guys get? No? Oh, okay. All right. And so coming down here, kind of the same as up above, we're going to add these two, the liabilities together. But then we're going to take basically all of the entire equity section of the parent company is going to come over. So and again, here's the consolidated financial statements. Just like that. I'm gonna have my kooky arrows in there, but everything else will be the same. Any questions? Let's take a break. Well, it's late. We're late for a break. How come you guys didn't throw a shoe at me? All right, let's say be back at sometime, say 7:20. Okay. Back to here. Okay, we'll go into chapter or problem 4. Okay, problem 4, looks like goodwill should be 6,000. You get that? Okay. I put it down at the bottom here. Okay, Sadie. And again, the stack one is a little bit strange now in that it has the beginning retained earnings. Different than what we did last time. Oh. Who's easy? Three. 20,000. Did that right? 25 plus that'd be 15. Yeah, I think that's it. All right. Okay. And assets. $400 for land, 300 for land. Goodwill was 6,000. Okay, dividend, Sadie, the D is for dividends. And these are unusual in that they actually get added into. Add into the investment account that we're trying to get rid of. And again, the reason we're trying to get rid of it because it'd be counted twice. This investment account is Bill, and so is this. So if we just jam these two together, Bill's gonna be counted twice. So we only want Bill counted once and then with our regular financial statements. Okay, I is income. Okay, so here we have I, oops, I. We add that into our investment accounts and now we're taking it out. I think it's something funny. I was when you get it to be like a CPA or a CMA or whatever, you have to do these continuing education things. And I was in one of these continuing education classes where you go around and you pick whatever area you go into. They have them at the hotels and stuff. They have a bunch of rooms, and you go into whichever room you want to attend. And I was in some really boring meetings, so I thought, okay, I'm just going to wander around and find something else. And they had this one on mergers and acquisitions. And so I just, oh, okay, I'll go and watch that one. It was actually very interesting about how these people actually go around and try to put together deals, basically. You know, they'll look for people who are willing to sell a business and people who want to buy them and try to get them, you know, together. And you know how I always thought that it was the people who are buying or selling them were the ones that were involved, but a lot of times they're not. It's these other people that identify, and they get a commission of, like, you know, whatever it is, 1 or 2% of the total. Okay, so building was for 4,800. And years. $480. Okay, so our excess assets will be expenses on the assets, I should say, will be, what do I use? We'll use red. Okay, so we're gonna put the additional expenses in here. We also could have gotten it by subtracting those two. But the bill company had for income minus what we had for their income should have been the 480. Yeah. And this one's also kind of weird in that it just gets taken off of the asset, not of the investment account. Because now we've depreciated 1 year's worth of buildings. Be eliminated. It's got a credit balance. We're debiting it. Be zero. And hey, they both are 18,960. So these two should be the same, and it makes sense because you already picked up the income from bill company. Already in there. Okay, this one, this is all the stuff from over here. Remember to subtract out the dividends. You don't have to put a negative sign in there. I'm going to put it in just because, oh, it's just the way I am. And again, these two numbers should be the same. And they are. And again, this $1,200 of dividends was never, it never left the business. You know, Amy Company owns Bill Company. That was paid to Amy Company. The only dividends that people were actually paid out to people were outside the company were 14,400. Okay. The merger guy that was talking about this one business this guy had that I think at the last moment this guy had like built this business up from nothing. He had 3 kids, none of them wanted it or whatever. Couldn't run the business. And so they found a buyer for him and he said, I can't sell it. I can't sell it. But he didn't want to have his employees not have jobs. So he gave it to the employees. It was a profitable business. And so then he ended up working on instead of a merger and acquisition by someone else buying it, that the employees, I was wondering how that worked out, but um, kind of a odd situation. Oop, one more. Yeah, if they ever don't balance, the two usual culprits are goodwill, probably the most missed one, at least by me, and this equipment account. So if you don't balance, look at these two accounts and make sure that you have those. I shouldn't have made those the same color as the expenses, but okay. And down here, add the liabilities together, so we owe 16,800 plus the 6,000. And then similar to what we have up, oops. It's just gonna be the owner's equity. All the equity for the subsidiary is gone. And these should equal. And they do. So the ones that are gonna be exactly the same are gonna be these retained earnings. You can just copy them over. Retained earnings are gonna be the same for Amy Company or the um parent company. And the only equity section are going to be the parent company also. Because these shares of stock and dividends and all that kind of stuff, those aren't paid to outsiders. There's no outside ownership. Whoever owns Amy Company owns this. And so their equity will still be over here, whatever's in their equity account. Questions? That's one of the last one. Or but if you don't want this one too. Okay. I'll do this one from scratch. Okay, so let's see here. So the assets are what we bought that are good. The liabilities that come with the place, we probably didn't want those, but you buy the whole place, you get the liabilities too. And so this will be what our total identified asset is. Is that right? Okay, cash price paid. All right, so goodwill, what, 750? So there's a difference here. And the difference there is 750, that will be our unidentified assets. Goodwill. Okay. 300, 600, and, okay. Well, now we can start. Look at the numbers in here. Oh, wrong spot. Hold on. Ah. uh, let's try that again. All right. So that would be two. Okay. Assets. 300, 600, and 750. Okay. So now we're all clean up until at the beginning of the year. And now we have to take care of the dividends, the income, and the expenses. So the income statement stuff. All right. Dividends. Again, no one got these dividends of 600. Oops. Yeah, sorry. Get rid of that. Here we go. No one got those dividends of 150. The parent company got it. They paid out their own dividends, but they were the total of 1,800 already there. And dividends are weird because you recall that we subtracted the dividends when we did the chapter one and the chapter one test. We subtracted the dividends, we get the ending balance of the investment. But now we're gonna unmix that cake. So everything that we added, we subtract, and everything we subtract, we add. And so that's why we're adding this back in. Okay, income. Oh, let me use that one. Make income purple. Okay, so we got that. SAID, we need the E. The E are the expenses. Building was 600. Divided by, it's 10 years again, right? Or 5, 10. 60. If I say something wrong, make sure you say something. And that's also for you guys playing at home. You find me saying crazy things, well, or putting crazy things up here, you know what to do. Okay, so 60 is the additional expense. And this one is a little bit odd too, and that it actually comes out of the asset itself. Because we've had this asset for a year. Man, are those two colors similar? Let's try a different color. Okay, there we go. Okay, so we've had those for a year, and now we're gonna reduce it. So we had 600 added to that account, now it's only gonna be 600 minus the 60. Okay. Start adding them up. Oops, that didn't work out. Oh, double minus. Yeah, that's right. Okay. They both match, and they do. And this is just basically everything from over here. The only difference that I usually do is I usually put this in as a negative because it does get subtracted out. If you don't put it in as a negative, that's fine too. As long as you get the same ending balance. Dividends do get subtracted, so as long as these two are the same. Okay. Cash, and again, you know, when you talk about the dividends, why they don't mean anything, you know, basically they paid 150 in dividends, so basically 150 is less on bill company and 150 is included in there. Nothing really changed for those. For your total cash, it'd be exactly the same. Really, you guys are in class here. If you ever want to take a picture, feel free to do it. It doesn't bother me at all. Okay, down here, we add up the liabilities, what we owe people. And then only the parent company's equity is left. So again, we can just those are exactly the same. No one has this stock included in the parent companies. Okay, and hopefully these balance. Yay, they do. Okay, any questions? All right, I'll leave that up for a minute and I'll come around and check these in. Okay. Good, you guys ready? Okay, that turn the examiner, make sure you turn it in. Well, and actually, that would be included in there. And that's what we're taking. Yeah. Yeah, so you're absolutely right that it is, the assets are in there. Yep. Any questions in the classroom or, you know, playing along at home? Okay. Yeah, frozen. I'm unfrozen. All right, well, I will see you guys next week. And we might start, let's go ahead and assume we're gonna start class at 6:05. Just, it'll reduce my frustration level of trying to get in the classroom, because I don't think that's gonna happen before then, so. We'll do 6:05 next week. Okay, anyone at home have any questions? Okay.
Thank you, Professor. Good night.
Good. All good here, Professor. Thank you.
Good.
Go.
Good
Night.
Bye. Good night, Professor.
night.